03, it's Tyson Company. The requirement of the question here is prepare the consolidated statement of profit or loss and other comprehensive income. So sometimes in exam, they ask you only to prepare a consolidated profit and loss, which means the top part. And sometimes they say other comprehensive income as well. So in this question, it requires both of them. Question is not really very difficult. It is more about some basic adjustments and overall the structure. We will learn how to structure this consolidated statement of comprehensive income. Otherwise, there are not many adjustments here. So Tyson Company, below are the statements of profit or loss and other comprehensive income OCI of Tyson Company, its subsidiary Douglas Company, and associate Frank Company. So they already have told you that Douglas is a subsidiary, Frank is an associate. If they do not tell, and in many cases they will not tell, you will have to find out that if it is a subsidiary or not, or if it is an associate or not. And in most questions, how do you do that? You see that if you have a holding of more than 50% or less than 50%, because actually we know that we need to see the control. For having a subsidiary means that we are looking to find out control. Control comes from ownership of ordinary shares, from contractual position, or ability to appoint directors. But in most cases, in exam questions, they don't express control in terms of position of appointment of directors or contractual things. Most cases, we only see that control is coming through shareholding. Anyways, in this question, they already have told you. One is subsidiary and one is an associate. Subsidiary will be consolidated by line item. We call it full consolidation. So we are going to add up all these things. And of course, we need to make some adjustments. And this associate, which is Frank, this we will use equity accounting, which is IS 28. And under equity accounting, we do not add up lines by line. What we do that we take the profit of the associate and we take the other comprehensive income, which is 5, and we take the percentage and we give it or add it here. So we add it to the group profit. We take our percentage, we multiply. For example, in this case, we'll see what percentage we own. For example, I can see that it's 40%. So we'll take 40% of 10 million, 40% of 5 million, and we will just ignore these things. Okay. Now, coming back to, I'm not going to read these numbers. It's not important to read numbers at this stage. Let's see the notes. You are given the following information. Number 1, Tyson Company acquired 80 million shares in Douglas Company for 188 million 3 years ago. When Douglas Company had a credit balance on its reserves of 40 million, Douglas Company has 100 million ordinary shares. So out of 100 million, you are buying 80 million, so 80%, so that's control that subsidiary, Douglas Company. Tyson also acquired 40 million shares in Frank for 60 million 2 years ago. When that company had a credit balance on its reserves of 20 million, Frank has 100 million ordinary shares. So 40 million out of 100 million, 40%, so that makes it a subsidiary. They have given us this information that how much consideration you paid, how much were the net assets, the reserves and net assets, in case you need to find out the goodwill. By the way, goodwill is always only for the subsidiary. We said this before as well. For associates, there is no goodwill. Goodwill is only for subsidiary. During the year, Douglas Company sold some goods. Now, Douglas is the parent, and parent company is selling goods to Tyson, which is, no. Douglas is not parent, I'm sorry. Who's parent? Douglas is subsidiary, Tyson is parent. So what is happening? Goods are being sold by Douglas, which is a subsidiary, and it is selling to Tyson, which is a parent. So subsidiary is selling to parent. So whenever you have intra-group transaction, you have unrealized profit, provision for unrealized profit, PUP, and that PUP actually is adjusted. And when subsidiary is selling to the parent, so it means that the unrealized profit, it lies within subsidiary. So we have to decrease or adjust the profit of subsidiary and then calculate NCI share. This is important to remember always, that you need to see that there is an unrealized profit and how much of that it is. For example, during the year, Douglas sold goods to Tyson for 66 million. The cost was 48. None of the goods had been sold by the year. Extremely simple. There is no goods were not sold. Everything is in stock. So 66 minus 48, 18 million. 18 million is unrealized profit. And this 18 million unrealized profit should be subtracted from the profit of the subsidiary. And then you will, after subtracting, you find out the adjusted profit. And then you give 20% of that to NCI. Okay. Because subsidiary sold goods. If the parent had sold goods, then you would have subtracted this 18 Tyson Company's profit, and non-controlling interest would not be affected with this thing. Number 4, it says that group policy is to measure non-controlling interest at acquisition at fair value. Whenever you are told that NCI is measured at fair value, which means the market value, you remember that this thing has an implication. We discussed it in previous lesson as well. That whenever NCI is measured at fair value, it means that the goodwill belongs to the parent and belongs to the NCI. And if there will be any impairment of goodwill, that some part will go to the parent, like 80% of the impairment of goodwill should go to the parent, and 20% of that should go to the subsidiary. I don't know there's an impairment or not yet, but I only know that whenever I receive fair value, I will always keep in mind that, oh, it's on fair value. If there will be impairment, I'm going to give some part of impairment to the NCI as well. So whenever you see fair value, always be careful. The fair value of non-controlling interest in Douglas Company at acquisition was 40 million. And of course, non-controlling interest will only be in Douglas, will not be in Frank, because Frank is not your subsidiary. In fact, you are non-controlling interest in Frank. Always remember, this is very interesting. I mean, I'm going a little bit away to make you understand some concept. See, this is Tyson, the parent, and this is Douglas, the subsidiary. Tyson purchased 80% in Douglas. So it means that in Douglas, there is someone else who is 20%, and that someone else is called NCI. Okay. Now, then what happened? That Tyson also had this company which is called Frank, and Frank was an associate, and Tyson purchased 40% of Frank. So now 60% belongs to someone else. Now, that someone else is actually the parent, because they have 60%. You, Tyson Company, this time you are NCI. So if I'm sitting in Frank, if you are taking the books of Frank, you would say, Tyson, he's my associate, he's my non-controlling interest. Understand this point? Just like when you are Tyson, you are thinking that I'm the parent of Douglas and everyone else is non-controlling interest. But if you were making the books of Frank, they would be thinking that Tyson is our non-controlling interest. I'm not fully recovered still. So we were discussing this last note. So group policy is to measure non-controlling interest at fair value. The fair value of the non-controlling interest in Douglas was 40 million. NCI at acquisition was 40 million. An impairment test carried out at the year end resulted in 15 million of the recognized goodwill relating to Douglas company being written off. So again, they made your life easy. They did not ask you to calculate, the impairment of goodwill. I mean, under many questions, they will tell you here that the goodwill in Douglas at the end of the period, the goodwill in Douglas was say 50 million. They will only tell you this thing. So when they tell you that at the reporting date, the goodwill in Douglas is for 50 million, then they're actually asking you to go back and find out what was the goodwill here. So then you need to calculate the goodwill and see if it is more than 50. Let's suppose it is 60. And then you say, oh, there is an impairment of 10 million. So then you need to do some calculation. But in this case, they straight away tell you that there is an impairment, which is 15 million. And it happened in Douglas. And in Douglas, the NCI is at fair value. So it means that this 15 million, we are going to distribute between the parent and the subsidiary. And of course, 80% will be taken by Tyson, the parent, and 20% will go to the non-controlling interest. Not to the non-controlling interest, because I'm going to subtract this 15 million from the profit. Remember, I see that the profit here was 55 million of Tyson company. So from that Tyson company, I would take this away. Okay. And the recognition of impairment losses of 2.4 million relating to the investment in Frank. So now here, investment in Frank has been impaired by 2.4 million. So what does that mean? Am I going to decrease Frank's profit by 2.4 million? This is Frank, remember, and this is their profit, and this is their total comprehensive income. Am I going to decrease it from there? Answer is no. I'm not consolidating Frank. And it is not that Frank has lost value or Frank profit, there's a loss. Frank is doing perfectly fine. Leave it alone. My investment only, which we made. How much we made? We made an investment. So in case of Frank, what happened? We have made investment of 60 million. So our initial investment in Frank was 60 million. Plus we will take profit 40%. We will add up minus we have a loss of 2.4 million in Frank. And this will tell us the number, which is our closing investment in Frank. Remember, this is actually the way you do calculation of NCI for others. When you are doing calculation of NCI, what do? Initial value, NCI at acquisition plus profit minus any losses. The same thing you will do for yourself now, because you are NCI in Frank actually. You are 40% in Frank. So you will say, okay, what was my initial investment in Frank? 60. This is with me. How much profit Frank made? Frank, whatever profit Frank made, 40% of that belongs to me. I will add it up. And then there is an impairment of this 60 million or whatever. And then I will subtract this 2.4 million loss. And this is my final value of my investment in Frank. So we did some discussion. Now let's start doing the workings. Now we know that when we make this statement of profit and loss, let me call it consolidated statement of comprehensive income for Tyson company for the year ending 31st December 2008. First line is always revenue, second line is cost of sale, third line is gross profit. Then if you have other income, we don't have other income, we have other expenses. Then we have got finance income. Just writing down all of them. I'm not sure if I need all of them, but I'm just writing down finance income. And profit before tax. Okay. And then in revenue, what we need to do, we know we are going to consolidate only the parent and the Douglas, which means revenue should be 500 million plus 150 million. And minus that group sale was given here as 66 million. So I will subtract this number. Minus 66. By the way, please pay attention to the dates. So we are doing a full 1 year consolidation because it says that you purchased this entity 3 years ago. So it means that for the last full 1 year, this 31st of December 2008. So the entire 2008 year, you were the parent of this thing. If they had told you that you acquired the company on, I don't know, because you are preparing on 31st of December. If they told us that Tyson, it acquired Douglas on 1st of July, 2008. If they tell me like this, that Tyson acquired Douglas on July 1st, 2008, and I'm preparing on 31st December, 2008, then this entire this income statement, we are not the parent for the full period. We are parent only for 6 months. In that case, you should have made it a proportionate thing first, like not 150, but 75, not 80, but 40, not 70, but 35, and 10, and 5. So 6 months, 6 months you should have taken, and then you should have added these numbers. Okay. So in income statement, always pay attention to the date, that if they have given you the full 1 year of income statement, were you the parent for the entire year or not? In balance sheet, this is not important. So this is my group revenue. Group cost of sale was parent cost of sale plus subsidiary cost of sale minus intra-group sale. So I would say that 270 plus 80 parent cost of sale plus subsidiary cost of sale minus intra-group sale, just like we wrote above, and plus unrealized profit. Plus unrealized profit. And unrealized profit was PUP. You need to see that how much was, I would write down here PUP, unrealized profit. Intra-group sales were 66 million. Cost of sale was 48 million. And this is my intra-group profit. And in stock, how much is in stock? 50% or 20% or 30%. They told us that 100% is in stock. So I would say that unrealized profit is 18 million. All of that unrealized profit is 18 million. Let me put it here, working one. I'll come back again here up, and I would say PUP is actually 18 million. And then we need to take it here, copy paste, we put equals to sign, and I'll add it, multiply it with -1 so that I get a negative number. And this is my now gross profit for the group, 282. Other expenses are how much? Other expenses, usually what we do, usually we add up these other expenses like 150 and 20. So you can fairly say that this is 150 plus 20. But here you need to pay attention. You have a goodwill impairment. Now, impairment of goodwill is in administrative expenses. Sometimes they tell you that impairment of plant and machinery has happened. So if there is an impairment of an asset which is related to the production process, so impairment of plant and equipment usually go into the cost of sales. Impairment of your administrative assets, they go to other expenses. By default, goodwill should come into admin expenses. But sometimes they will tell you that it is the company policy to charge goodwill to the cost of sale. If they tell you that charge goodwill impairment to cost of sale, then you will put in cost of sale. If they don't tell you, take it to the other expenses. So we have got 15 million of recognized goodwill. So what we are going to do, we will add up here plus 15. So my admin expenses actually have increased because of that goodwill impairment. Understood? Or you want to ask something? Then after this, we have finance income. Finance income is 15 plus 10. All of that is 25. And let me put it minus 25. Then I have finance cost. Finance cost is only the parent, which is Tyson. Douglas does not have finance cost, so I put it minus 20. And then we take our profit before tax, which is 52. Now, if you see here that the profit which was given by individual financial statements was 75 and 60. But if you make a total of 75 and 60, 75 plus 60, it gives you 120, 135. From 135, 15 million was finance income should be added. Yeah, that's what I was, because I always try to do some kind of this finance income. There should be actually 25. That's what I was thinking, because these numbers do not match. We always do sense check, you call it, when my accountants are giving me some statements. So the number come here, but you always do a sense check in your mind. Does that make sense or not? So 15 million, I would subtract for this goodwill impairment, which we have done there. So it makes me 120. And then 18 million we subtracted from the intra-group transaction. So 102. And this 102 I get it here. So that makes sense that we are doing it correct, because there's always a mathematical side of balancing the things. Okay. After this thing, you've got income tax expense. Income tax expense is 25 and 15 for the two companies, 25 plus 15, and let me write down here minus 40, and we call it profit for the year. So profit for the year. And after profit for the year, we have other comprehensive income. Other comprehensive income, gains on property revaluation, net of taxes. They already have told you gain on PPE revaluation, which is net of taxes. So you don't need to calculate tax impact here. They already have given you that it is net of taxes. And how much is that? It gives you 20 plus 10, and that makes you 30. Okay, 30. By the way, profit for the year, when you make here, I should add one more line. Profit for, because I need to add my here in this number which is 102. I need to, before this number, I need to put my associate shares as well, because there's a share of associate as well, and that I need to put here. You call it share of associates profit. Okay, so how much is the associate profit? How much associate is making profit? Yeah, please. Associate's profit.
Five.
Income tax expense. There.
Again,
Huh? How much is associate's profit? Let me do it. See here, in associate, you have two numbers. Let me tell you what will happen. In associate, you have one this profit for the year, and one is your other comprehensive income. So we need to take our share from both of them, and we will be taking 40%. 40% we will take from here, and 40% we will take from here. In effective, we are taking 40% of 15 of total 15. So total is 15, and we need 40% of the total, but we need to show it separately. So we will not take 40% of 15, we'll take 40% of 10, and then 40% of 5. So for the purpose of this, presentation purposes. And they will be added accordingly. So here, profit before tax, 102. Before that, I will take my share here, which is 10 times 40%. 10 times 40% is 4. And if I see now, I need to take it like this. But then there is one more thing, if you remember the adjustment. This is what sometimes we get confused and make mistake in consolidation that we forget. This is 2.4 million loss. So we have a loss, not Frank has a loss. It is not Frank's loss. I'm not going to adjust 2.4 million from Frank, the associate's profit and loss account. This is loss for the parent. So this, whatever I'm getting, I need to subtract from here 2.4 million. 2.4 million I need to subtract, which is our loss on investment. So we'll say 4 minus 2.4. So Frank made a profit. From that profit, we take our 40% share, which is 4 million, but probably the value of investment has gone down. Maybe the Frank share value has gone down because we purchased 40% shares of Frank. So on one side, Frank is giving me profit. Okay, I made a profit of 10 million, you take your 40%. This is 4 million to you. So I'm happy that I get 4 million profit, dividend, whatever, not dividend, but profit from Frank. But then I see my share prices. I purchase shares in Frank for, say, I don't know how much, 60 million. I purchase the shares in Frank for 60 million. But the market value of these shares now is not 60 million. It is probably something like 57.6 million. So I made a loss of 2.4. So 2.4 is my loss. 4 million is my share of my profit. So I will record a net amount of 1.6 million. This is, I'll say, share of associate profit, 1.6 million. I get profit before tax. Then I pay tax expense was whatever it was. Profit for the year is 63.6, and other comprehensive income here. And then I have also, I need to show, OCI, the OCI part of that Frank. OCI, other comprehensive income of associate. Okay, or let me call it share from OCI of associate. So how much is OCI? Frank's OCI is 5, and from this 5, I take my 40%, which makes me 2 million. So I add this 2 million here as well. So if I see my total comprehensive income here is 32 million. So this 30 and this 30. So now this is called TCI. TCI means total comprehensive income. So two things are here. 63.6 million is your profit, which you call your operating profit. And operating profit was 103 million. Profit after tax was 63 million. Other comprehensive income of Douglas and Tyson, parent and subsidiary, and the parent's share in associate 2 million. Total comprehensive income is 32. And now we need to present it like how much of the 63.6 should go to the NCI and how much should go to the parent. For example, we need to, this is like a requirement that we have to show. We'll say that, profit attributed to parent and profit attributed to NCI. So this was 63.6. I need to divide it between the parent and NCI. And then I would say OCI attributed to parent, and then I would say OCI attributed to NCI. So I need to show it separately that this 32 million, how we are going to split it between the parent and the subsidiary. So two numbers we have to split. 63.6 will be split between the two, and 32 million will be split between the two. If you've got any question, please ask me. We need to take out our share from this $10. This is the profit. After tax, profit for the year, $10, we will take 40%, and then other comprehensive income, and we'll take 40%. So this is what we need to do. So what we do that, we will say, okay, we have already done that 20 and 40. I got lost. Now we are talking about NCI. I'm sorry. We took a break and I got lost. This is done. This is done here. Okay. This is done. Now I need to do what I need to do from this 63.6 and from this 32. I need to give the share to NCI. Okay. So what we do here, we need to make one short working. We'll say as per financial statements, and we have here profit for the year, and we will say OCI for the year. Okay. Profit for the year and OCI for the year. So we are talking about here, let me call it NCI share in, what was the name of the company? Douglas. Or NCI at reporting date. Let's call it like this. NCI at reporting date. So NCI at reporting date, where is NCI? NCI does not exist in this case because we are not consolidating it. This profit 63.6 is actually a total of these two or whatever. And this 32 is a total of these two, like this. So we have, and in this company, Douglas, there is only the NCI here. So we need to see that how much we are going to give or how much of the profit are we going to share to NCI out of this 63 million, what belongs to the parent and what belongs to the NCI. So profit attributed to parent and to NCI, and other comprehensive income attributed to the parent and to the NCI. So we are talking about distribution of Douglas financial statement. And from here, I can see that profit here is 45 if you pay attention. And the total comprehensive income is 55, which means 45 plus 10, 55. So I will write down here, profit for the year is 45 and not OCI, let me call it PCI. Total comprehensive income for the year is 55. So out of this 45 and 55, how much I'm giving? I'm not giving from 63. I'm sorry for saying that expression because 63 is a total of Douglas and Tyson, parent and subsidiary. Because this 63, it is a total of the parent plus subsidiary. NCI does not exist in parent. NCI exists only in subsidiary. This is parent plus subsidiary. Okay. NCI is only only in the subsidiary part. So NCI will get profit from subsidiary's profit, not from parent's profit. 45 and 55. This is as per financial statements. But then I know that this Douglas company, it had some unrealized profit. Okay, because Douglas sold goods. Douglas sold goods. If you remember this thing, Douglas sold goods to Tyson, which means that the unrealized profit of 18 million, it actually exists in Douglas income statement. So that 18 million I need to subtract. I'm just calculating the adjusted profit of Douglas. The profit of Douglas is 45, but inside of 45, 18 is unrealized, so I need to subtract it. If parent had sold goods, then you did not need to take this thing. Then you can ignore this thing. If parent had sold goods, here parent is not selling goods, subsidiary is selling goods. So subsidiary profit includes the unrealized profit. So we subtract that thing, 45 minus 18, which makes it 27, and we put it here. So this is like this. So after this thing, this is adjusted profit. Let me call it adjusted profit of subsidiary. Clear? Now, after this thing, there is an impairment loss. And actually, I should take it a little bit down. I should subtract this thing, impairment loss, also in the beginning. I would say impairment loss, because impairment loss on Douglas acquisition, Douglas goodwill, which is 15 million. So Douglas is not making anything actually at all. What is Douglas making? So their profit is 12 million only, and 22 million is total comprehensive income. So this is adjustment profit of subsidiary. From here, you will say NCI share, which is just 20%. Okay, so you will take 12 into 0.2, and from here 4.4. So NCI might be expecting that I should be getting 20% of 45. He might come in and say, give me my 20% of 45, which means 9 million. I say, no, wait a minute. I'll subtract this thing. Net is adjusted is 12, and from 12 you get 20%. So don't expect 9 million. You will be getting only 2.4 million. So that changes the scenario a lot. And now you say profit attributed to NCI was 2.4 million, and attributed to parent is 63 minus 2.4, and then OCI attributed to NCI would be 4.4, and OCI to the parent would be, and I actually need to make here this is OCI, and then I would say TCI, total comprehensive income. I need to make a line here. The TCI would be 63 plus 32, the sum total of these two, okay, 96, 95.6. So 4.4 goes to the NCI, and remaining 95.6 minus 4.4, that 91.2 goes to the parent. So these things you need to show separately. If you got any question, please ask me. No, because this 32 is other comprehensive income, but total comprehensive income would be profit plus OCI, that gives you TCI. So TCI is your total comprehensive income, which is a total of OCI and profit. Any question until here? This is done. This is the final presentation. You need to put this number as it is like this, and you have to show that how much of the profit goes to parent and NCI, how much of TCI goes to parent and NCI. Any question until here?